Hi everyone, Chris Stanton here from the law firm of Klemp and Stanton in Mendota Heights, Minnesota, and this is the second of my estate planning presentations that I'm doing for your enjoyment and your education, of course. Please note that this presentation is only going to be roughly 10 minutes in length and is designed to be simple and understandable for the average person. Now today's presentation, I'm going to cover some basic things regarding estate tax. Specifically, does everyone have to pay estate tax, whether it be to Washington or to the state of Minnesota? Now, the short answer to that is no. Not everyone has to pay estate tax. It depends upon the size of your estate at the time of your death. So then the question then becomes well, what is included in your estate for purposes of determining whether or not you have to pay tax? Well, the assets that are included are the following. Well, your home, your bank accounts, your personal effects, your investment assets, including retirement accounts, and life insurance is included in your estate for estate tax purposes. Now, why have I, circled it, making a big deal? Well, a lot of times people think that life insurance is tax free. Well, it is income tax free, but it's not estate tax free. The death benefit from your life insurance is included in your estate, just like any of these other assets here. So if you had a house worth 400,000 and you had bank accounts of 100,000 and retirement accounts of 100,000, well, you would think then your estate is roughly at 500,000-600,000, right? Well, if you have a life insurance policy for $1 million, well, as far as the government's concerned, from an estate planning standpoint, you're worth 1.5, 1.6 million. So you need to make sure when you're calculating whether or not you have to worry about estate tax, you need to include the death benefit of your life insurance. Okay, now, state of Minnesota has two different types of estate tax to pay attention to. You got your federal estate tax and you have your state estate tax. There's separate taxes. You may have to pay one and not the other, and vice versa. Well, how does that work? Well, currently the federal exemption is $5.25 million, meaning you can pass up to that amount and not have to pay any estate tax. The state of Minnesota, however, isn't quite as generous. They only allow you to pass $1 million. Anything over $1 million is going to be subject to a tax. So it's possible that you would have to pay the state estate tax, but not pay the federal. How would that occur? Well, you're over the million, but below the 5.25 million. In that situation, then you'd have Minnesota estate tax to worry about. Now, let's take a look at these taxes separately. First of all, you got your federal estate tax. The federal estate tax exemption, as I mentioned, is $5.25 million per person. If you have properly prepared documents, if you have properly prepared wills or properly prepared trusts, between a husband and wife, they can pass $10.5 million without incurring any estate tax. If you're not properly prepared, between a husband and wife, you'd end up wasting or not using one of these $5.2 million exemptions, and anything over the $5 million mark would be subject to tax instead of 10. If you do have to pay any federal tax, you're going to be in the neighborhood of 40%. So it's a pretty stiff tax. You want to make sure that you use your exemptions effectively if you're in and around that $5 million mark. Now, the annual amount that you may gift is $14,000 per year per person. Between a husband and wife, they can pass $28,000 to, for instance, each one of their kids without running into any problems with their death exemption. It is used quite often as a way of reducing the estate prior to their death. So if you're in this situation where you have a fairly substantial estate, do begin gifting. It will remove the proceeds from your taxable estate. Now, let's look at the state of Minnesota. The state of Minnesota isn't quite as generous. They allow you to pass $1 million. If you use your exemptions effectively between the husband and wife, you can pass $2 million instead of $1 million. Now, I have a lot of clients that are between this. They may have, $500,000 or $600,000 in assets, and they might have $700,000 of insurance. Well, as I mentioned before, now you got in excess of $1 million estate. It's closer to 1.2. The 500,000 plus the 700,000 of insurance puts you over the million mark, but below the 2 million mark. So if they're properly prepared, they should have to not pay any estate tax. If they're improperly prepared, anything over that million mark is going to be subject to a tax, running from roughly 9% to 41%. Again, the annual amount that you can gift to individual beneficiaries is $14,000 per year per person. Now let's look at some of the numbers relating to the Minnesota state estate tax. Here we have the estate value in this column. This is the corresponding tax that goes along with it. So if you have a $1,050,000 estate, the Minnesota tax, believe it or not, is $20,500. The estate value here in this example, 1.3, the corresponding tax is $51,600. If you had a $2 million estate and you didn't use your exemptions effectively between the husband and wife, then they'd end up having to pay $99,600 in tax. Now, let's look at some examples. I've always been one that if you're explaining things to me, give me some examples, and that's what I'm going to try and do for you right now. So let's assume we have John here with his $1 million exemption, and this is Jane. They each have a $1 million exemption. If they use them effectively, they'll be able to pass $2 million onto their children without incurring any Minnesota estate tax. Now, it's very important. The one thing about John and Jane, in order for them to be able to use their $1 million exemptions effectively, they're going to need to have provisions written into their will or their trust, creating what is called a credit shelter trust. Another term would be bypass trust, or family trust is another term that's commonly used. These provisions need to be written into the will or into the trust prior to the first death. Can't stress that enough. You know, if you don't have properly prepared documents and one of them dies, then we're going to end up wasting one of our $1 million exemptions, and we'll be paying some unnecessary estate tax. Now, let's look at some examples. Let's look at improper planning before we talk about proper planning. In this example, we have a $1.5 million estate. Okay, $750,000 with the husband, $750,000 with the wife. They're above the million mark, okay, but they're below the 2 million mark, and they shouldn't have to pay any estate tax unless they do this. What happens commonly is if husband dies, everything would go to the wife, and that's fine on the first death because there's what's called an unlimited marital deduction. So it might say in the will, if something happens to me, I give everything to my wife, and upon my wife's passing, she can do whatever she wishes with it. Well, if that's the case, then we'd be in a situation where Jane had a $750,000 estate. She got $750,000 from her husband, and now she's going to be worth $1.5 million. Again, that's fine as long as she's alive. But one day, that's it for Jane. Well, now the state of Minnesota is going to say, well, what's Jane's estate worth? Well, she's worth $1.5 million. What's her exemption? $1 million, leaving $500,000 taxable, or a $64,400 tax. Well, I just got done telling you that there shouldn't be any tax. You have $2 million in exemptions. This is only a $1.5 million estate. What happened? Well, what happened is when John died, he just gave everything over to Jane. That pushed her up over the million mark, and what the government's interested in is what is the survivor of the two of them worth? They're not so much interested upon the first death. They're just interested upon the second death. And by just piling everything onto Jane's estate, that pushed her up over the million mark that she's allowed to pass and caused tax that shouldn't have to be there. Well, let's look at another example. This one happens to be a $2 million estate, or $1 million apiece. Now again, in the will it says if John dies, everything goes to Jane. Jane says, thank you very much. I've got $1 million to begin with. I've got now $1 million from my husband. I'm now worth $2 million. And again, that's quite all right upon the first death because of the unlimited marital deduction, but then that's it for Jane. Well, that's again when the government's going to come knocking, and they're going to say, "What's Jane's estate worth?" Well, she's worth $2 million. Well, what's her exemption? Her exemption's $1 million. Leaving $1 million taxable, that turns into a $99,600 tax. There should be no tax to be paid on this. If they used their exemptions effectively, they would have been able to pass $2 million without incurring any estate tax. Well, what do they need to do? What is proper planning? Well, what they need to do is they need to have wills or trusts prepared that says within the terms of the will, if John dies, for instance, everything would go to Jane, but this time she has the ability to disclaim some assets. And if anything is disclaimed, it's going to go into a little side trust. This side trust is called a credit shelter trust. This is kind of an overflow trust. Anything that would put Jane over the $1 million mark, she might want to consider disclaiming, and she'd have up to 9 months after John dies to make this decision. This isn't something she's deciding at the time of the will was created or when she was talking about it. It just needs to be decided upon within 9 months of John dying. Now, in this example, we have John at $750, we have Jane at $750. She knows she can go to $1 million without incurring any estate tax. So under those circumstances, she'd probably only accept $250 of the $750 from John and disclaim the remaining $500. Okay? And again, she'd have up to 9 months to make that decision. By the way, this $500,000 isn't a particular type of investment. It could be in land. It could be in mutual funds. It could be in the bank. But any income that's being generated from these disclaimed assets would go to her for life, with the principal being in reserve. So if she needed this money back, she could get it. This goes on for the rest of her life until one day she dies. Well, that's when the government would come knocking and they'd say, well, what was Jane's estate worth? Well, she was worth $1 million. Well, what's her exemption? Her exemption's $1 million, leaving zero taxable, and as a result, zero tax. So these monies that she has would go to her beneficiaries, estate tax free. Okay? And these monies would also go estate tax free to the beneficiaries. Okay? Now in this example, we're saving $64,600 of tax. Not by anything magical. This credit shelter trust just represents the husband's exemption that we didn't use at all in the earlier samples. Now we only used it to the tune of $500, but it's conceivable that we can put $1 million into this credit shelter trust when he dies and keep it out of Jane's estate. Now let's look at the next example. Here we have a $2 million estate. Some more proper planning. Same thing as before. Something happens to John, everything goes to Jane. She would then disclaim, more than likely, the full $1 million because she has $1 million of her own to begin with. All right? So we have $1 million in the credit shelter trust. We have $1 million in her direct control. And this goes on when she has the interest income going to her for life, with the principal being available, until one day she dies. Well, then that's when the state will say, well, what's Jane worth? Well, she's worth $1 million. Well, what's her exemption? Well, her exemption's $1 million, leaving zero taxable, and as a result, zero tax. Okay? So in this example, we're saving $99,000, almost $100,000, not by anything magical. Again, this just simply represents the husband's exemption. Rather than piling it onto Jane's estate, we put it in a different place where it wouldn't be included in her estate for estate tax purposes. Okay? Now, how does the credit shelter trust work that we just talked about? Well, these are just tax provisions that are written into the will or into the revocable trust prior to death, giving everything to Jane, but giving her an option to disclaim assets into the credit shelter. I need to mention that this is an option. If it didn't make sense to disclaim to the credit shelter trust, in other words, they didn't have a big enough estate, or the exemption was increased to a point where there was no need for her to put money in the credit shelter trust, she could disclaim zero. Okay? Now, upon John's death, Jane has up to 9 months to make this decision to whether to disclaim assets. Assets that are disclaimed will be owned by this credit shelter trust and will have a separate tax ID number. Okay, Jane will receive all the interest income from the disclaimed assets, plus have the principal available if she needs it. Upon Jane's death, the assets that are in the credit shelter trust go to the beneficiaries, estate tax free. It's incredibly important that if you're over the $1 million mark, including life insurance, that you have proper provisions written into the will or into the trust. All right, so this concludes our discussion on whether or not everyone has to pay estate tax. My name's Chris Stanton. I'm with the firm of Klemp and Stanton. If you'd like to call me and talk to me about this, I'd be happy to do so. I'm at 651-310-1400. My email address is cts@klemp-stanton.com. Until next time, have a nice day.